Hello everyone. So now we are starting with a new topic of discussion, that is the holistic review of the March market turmoil. This is basically discussing about 2022 March, and we all know what happened during the time was the COVID crisis. Clear? So this chapter is basically divided into three parts. The part one is discussing about the market, what happened actually in the market, okay, during that particular pandemic. And the second part is basically discussing about the different financial forms of market, or we can say the market products, okay, just like what will happen to the money market mutual fund, open ended mutual funds, okay, exchange traded funds, equity market, bonds market, everything will be covered up. Clear? So impact on financial product, impact on financial product. And the last one is the policies, okay, which was drawn up by the government, okay, the government as well as the central bank of the particular nations to overcome this financial issues, this financial concerns. Clear? So we'll start step by step like before. Make the proper chart, everything will be covered up so that you will not miss any point. Now this particular market is further divided into different subsections. Now over here, the first part is before the crisis. Clear? Then the first stage of crisis. So first stage of crisis, then second stage of crisis, and then the third stage of crisis, means how that particular thing have evolved. Now the next point which is covered is the origin and backdrop. Origin and backdrop. And the last point is its impact on NBFCs, okay, non-banking financial institutions, NBFI, non-banking financial institution. Clear? Or you can say NBFC, non-banking financial corporation. Now don't consider them that there are so many points. It's very simple that before the crisis, the market of US, the Asian market, the European market, they were at all-time high. Clear? Before the crisis. Then we all know what happened after the crisis, the market fall down. So write down, in the first phase of market turmoil is the market crash. Everyone were afraid of abrupt in the economy, okay, they are assuming that there will be a major downturn in the economy. So in every market across the globe, we have seen a sell off in the market. So now what is happening? People transformed from equity market to bonds market. So there is a huge sell off in the equity, so because of which the prices of the equity reduced, and there was a huge buying in the bonds, because of which the price of the bond will increase and the YTM, the yield of the bond, will start falling. We call this as flight to safety, because we are moving toward the sovereign bonds, okay, which are considered to be as the safest asset on the earth. Clear? Now there are some of the assets which are illiquid in nature and riskier. So there we also have seen the liquidity crunch in the market because of the huge sell off. Even the smaller market have seen the circuits in the market have been closed for a few hours just to stop the trading, but again when market opened, market have seen the same impact. So if there are bonds which are considered to be as the risky, their spread will rise, okay, spread is known for the amount of risk. Clear? Also we have seen the oil prices, a drastic fall in the oil prices, okay. Why that drastic fall? Because the economy was closed, there won't be any demand, so the countries which are totally dependent on the supply of the oil, like Middle Eastern countries, they have suffered a lot. So these all happened in the first stage of the turmoil. Clear? Now this was the start of the March, and now let us enter into the middle of the March, where we have seen that people have already transferred their cash, or they have transferred their money from equity to either cash or to the sovereign gold bonds. So in the second phase of market turmoil, we have seen that lockdown persisted. Okay, many countries have locked down their cities, so food outlets, traveling, visiting, tourism, aircraft, okay, even hospitality, all those sectors have suffered a huge amount of impact. There was no business, whether it's you consider as a metal sector, there was no need for the metal. Electricity consumption reduced because the factories are not running. So there was all round issues, but there was one sector which was running more than expected, is the pharmaceutical sector, and they have shown such a huge growth at that point of time that no one expected. So in the second phase, what happened? The most important thing, people wants cash. Okay, many people have lost their job, many people have lost the business. So what happened? The mutual fund, people start selling off their assets in the form of mutual funds. Now the brokers are asking for the more margins. Why? The volatility have increased, so people need more and more cash. Okay, the volatility has increased in the market. Clear? Even the financial institution, the large financial institution, they are also coming out of the market to safeguard themselves. It is becoming difficult to raise the cash at that particular point of time. Clear? People have sold most of their liquid assets so that they can get the cash with them. Okay, we have seen in the money market, the commercial paper, certificate of deposit, even they have also faced a huge amount of liquidity. That will come up in the next portion when we will discuss about all those financial product, that what happened, actually what happened to them. So the issues was, write down, there was a problem of cash, there was a problem of cash, there was a problem of liquidity, there was a problem of liquidity in the market. So we all know what will happen in the liquidity. There are two type of liquidity issues. One is the funding and another one is the market. So in the market liquidity, we have seen that there is a very high bid ask spread, and even in the bonds market there was very low amount of liquidity. Clear? Even the demand for the commercial paper and certificate of deposit have decreased. So banks are not getting the money, and when banks don't have the money, they cannot circulate it into the market. So the whole cash flow in the market have actually dropped substantially, and the volatility is at the all time high. Clear? And we have seen there are many assets which have shown the worst amount of values, like oil, like metals. Okay, there was a huge impact on it, all because of the cash crunch as well as the liquidity. Now write down the third point in the same section, that is the price difference. Price difference. Now what is the meaning of price difference? They are saying that if you have two assets A and B and they are highly correlated, then the rise in price or fall in price must go together. But there was a variance in the pricing of these two assets as well, even though they are highly correlated. Clear? Or what are those two assets? One is the treasury bond price, and another one is the future price of the treasury bond. So means if one side you have the bond and another side you have the futures on that particular bond, they are highly correlated, but we have seen the prices are moving differently for both of them. Now apart from that, there was a rise in the dollar as respect to other countries currencies. Okay, you can write down in short way, like appreciation of USD relative to other currency. Appreciation of USD in relation to other currency. Now why? What is the reason for that? The reason is the demand for the US dollar in the market. The demand for the US dollar in the market, because we all know that everything is around the globe is traded with the help of the USD. Whether you will take commodities, whether you take US oil, everything is dependent on USD. Clear? So there was a huge need for the USD, but because of the liquidity crunch in the market, the companies are unable to issue the bonds. Okay, so anyhow they have to sell off their assets to get the US amount. Clear? Now, the third step is actually the remedial action taken by the central bank. Okay, they started purchasing the liquid assets from the market. So, if they are purchasing the asset, means what? They are giving the cash into the economy. Okay, so economy is getting the cash. Liquidity is now going to improve. There were narrower spread. Why? Because there is a huge buying and selling starting in the market. Clear? So the cash flow started to come out in the market. Clear? So third step is to money supply give money supply and to improve liquidity in the market, and to improve liquidity in the market. Clear? Now coming to the origin and backdrop. So the same thing again came out, that in the market there was a huge downfall in the aggregate demand and the supply. Okay, now demand shocked because of many reasons, because of the lockdowns, because of the economic uncertainty. People don't have the money because they are unemployed, and supply shocks because of there was a shutdown, whether it's a travel, whether it's the business. So people have started to produce less, because considering that this is a global recession. Clear? But before the pandemic everything was going good. Okay, everyone was estimating that things will go very well. We have seen in 2007 and 9 that interest rate are falling continuously after that 2007 and 9 financial crisis. So even in the same recession of March 2020, everyone estimated that the interest will rate will keep on falling, like we have seen earlier. Okay, so they are assuming that the cost of financing will be much lower, so that they can take the leverage and take the benefit, whether it's an individual or corporation. See, at the end people need money, and when they'll spend, the business will get money, and when business will get the money, they will produce more. Again, when they will produce more, the employees will get the cash in their hand, they again spend it into the market. So this cycle will go on. This will provide a boost to the economy. There is an interest rate hike, so everything will go in a chain. Clear? So when people spend, when people invest, there is a huge liquidity. There is a hike in the price because of the demand. But because of this pandemic, everything turned around, everything like stopped, something like this. People lost the job, companies shut down. Okay, if you'll see people from the working, those who are working outside a railway station, okay, having their shops or sweets corner, snacks corner, everything stopped. Okay, and many people associated with that, whether it's a staff, working staff, cooking staff, everyone have faced huge impact because of this pandemic. So this point is totally discussing about its impact, that what has happened. Clear? Now coming to our next point, which is about the non-banking financial institutions. So now if you want to know about non-banking financial institution, they basically include all those investment funds, insurance companies, pension funds. Okay, now they constitute 50% of the total financial assets, which are totally in the investment funds. Now if you will see their wide range of investment and financing activities, or we can say services provided by the NBFCs, is to give the debt. Okay, Bajaj Finance is one of the example in India. They are providing the financing if you are going to purchase any TV, any car, anything. So they are an example of NBFC, and they are giving a loan, small loans to the individuals, even a loans to the small business owners. Okay, they have the new terms, new plans of giving the credit, which will become easier for the for an individual. They will not take any mortgage if you'll take any car or any mobile phone or any laptop. So the mortgage was not taken, so things become simpler, and they provide a service basically to the individuals to help them to initiate a buying in the market, to initiate liquidity in the market. So after doing all this, they have played a major role in the growth of the economy, because at the end they are giving a boost to the demand in the economy. Because suppose I don't have money to buy an iPhone, okay, so what I'll do, I'll go to the Bajaj Finance and I'll do the financing and I'll pay every month amount. But at the end I have purchased an iPhone, so means what, Apple company got their 60-70,000 amount of money. Getting my point? So this will create an economy boost up in the market. Clear? Now if we take ourselves on a global level, okay, rather than only India or any particular country, so we all know that the currency which is used widely for the purpose of transaction is the USD. Similarly, if you look at from the NBFCs, they want money, okay, they need to fund the customers, so they also need money, so they get money in the form of USD from different investors. So what they want is the stable flow of the USD, okay, because if the USD will not be stable, it will difficult for them to manage their business, to manage or hedge their business. Clear? Now there are banks, okay, if banks will do all the task, try to understand, if bank will give loan to all corporates, to all individuals, and they focus on small buyings as well, so can you see the whole amount of risk concentration will come inside the bank. So what happened, NBFCs came and they said that okay, we are going to take some part of your risk, we are going to take some part of risk. So credit risk is now less concentrated in the banking sector and held more by the investors, with the intermediate process being market based rather than directly through the bank. So means now people have more trust on the bank because their credit risk have reduced, and now NBFCs is coming up and take their part in order to handle those individuals and small business owners. They provide them service as well as they support them. Clear? But still don't assume that bank will lose their shine, because they are still a key player in the liquidity provider in the market, though their role have reduced, but still they are the key player. Okay, so we are done with the part 1, understanding all those market turmoils. Clear? Now coming to second part, all those products which have been impacted because of this global crisis. Okay, we start with the money market funds, then we have open ended funds, open ended funds, then exchange traded funds. These are the three. Write down. Next, repos. Further, here I am dividing. Okay, write down CCPs and margin. CCPs and margin. Write down next, short term funding market. Short term funding market. Next, government bonds and corporate debt market. Means, can I say the bonds? Okay, that bonds will include both government as well as corporate. So we have to study these 7 points basically, so that we can cover up. Now we all know the meaning of each of those 7. The only thing we need to understand is the impact of the market on these products. Now first of all, let us understand it from the repos perspective. What happened? The dramatic increase in the repo rate during that financial crisis. Okay, basically in the COVID crisis, there was a huge increase in the repo rates, which effectively increased the cost of obtaining cash. So because of which it reduces the amount of the funding available. Okay, so you can mention these in 2-3 points in your own words, that what happened during the repos. Again I am saying, there was an increase in the repo rates, because of which the cost of obtaining the cash got increased, and because of which the amount available also got reduced. Clear? Now let us understand this money market fund. So we all know that during this COVID crisis, what happened? People started shifting towards the safer assets, short term assets, as well as the assets which are more liquid. Clear? So money market funds, they have to rebalance their portfolios. Okay, earlier they have some long term, they have illiquid investments, non government assets. So there was a huge redemption going on, okay, for all those assets which have invested in the non government MF as well as the corporate illiquid bonds. Clear? So short term funding markets and the fund markets, they have moved their investment into the short term government securities. So means they are now shifting to US treasury bills. Clear? Apart from that, the banks have reported that the deposits by the individual and institutions have increased during the March 2020. So means people love cash, people are selling their assets and getting their money into the banks. Clear? So that they can buy more assets when market will stable. Now in the ETF, there are many ETFs as well as open ended funds where investors assume that the price of the asset is less than its underlying assets value. Okay, so there was a huge amount of selling in those open ended funds because of the investors feels that the current fund price was much higher than the value of the underlying asset, or we can say that as the NAV. Clear? So you can say equity and bond market, both funds, okay, both open ended funds, we have seen a huge amount of redemption. Clear? Where more redemption was in the bonds as compared to the equity. Now, we all know that the difference between the ETF and the open ended fund is the amount of liquidity. So, ETF are very well liquid, and their prices of the assets and the current price of the ETF, they are closely matched up. Okay, so because of which there was not that much huge selling as compared to the open ended fund. Even in the ETF, there was a disposal going on, there was redemption going on, but relatively, if I'll say, then ETF have the lesser amount of redemption. Now coming to the central counterparties and margin, and we all know that because of the rise in the volatility, the initial margin as well as the variation margin, or you can say maintenance margin, they all increased, and the people need to find out the cash in order to maintain their position. Otherwise, CCP will cancel off their position at net loss. Now the short term funding, okay, this takes me toward the commercial papers, okay, which are for a lesser number of days. Even over there also, many banks and many institutions have faced problem while raising the money with the help of the commercial paper, because the liquidity issues were there. Okay, people don't have enough cash in their hand to invest, so there was a huge sell off and redemption going all around. Now coming to the last, that is the bond. So as I said, people are shifting from the long term bonds to the short term bonds because they see the huge amount of liquidity. Okay, so we have seen in the second stage of the turmoil in March 2020, where the yield have increased because of the huge buying in the short term bonds. So when yield increase, okay, that yield increasing because of the illiquid one, because of the illiquid one, the spread is rising. But for the bonds which are safer haven, their yield reduced because of the high bond prices, because of the increase in demand. So there are two types of bond, one is safe and one is risky. Okay, so for the safer bond, the YTM actually reduced because of the huge demand, the price increase, YTM reduced. But for the risky assets, the demand was low, spread rises, so because of which the YTM also got increased. So when YTM will rise, the cost for the corporate debt will also increase. Okay, so these are all the different asset class and what happened during that point of time. And the last point is the policies, what bank and the government have actually done to control this type of situation, to bring the market back on track. There was a increase in money supply. Okay, there was a infrastructural expenditure done by the government, and money have been given to the people so that they can take this ahead, they can spend the money into the market. Government tried to open up the businesses So now central bank have started purchasing the assets from the market, so which brings the cash into the market, liquidity coming into the market. Now, apart from that, central bank also purchasing the corporate bonds, asset-backed securities, even the high yield ETF, so that once they will start purchasing, the people will start selling, the liquidity will come into the market, and this will create the flow of money into the market. Apart from this, the bid ask spread also narrowed down because from both sides they are getting the buyer and seller. So it also reduces the amount of volatility. It also reduces the amount required as well as the amount of margin calls. Apart from that, there were many relaxation given to the banks that they can keep lesser liquidity requirements. They can give the money at a better and attractive rate so that corporates can come out and they can borrow the money. They must purchase the assets. They start working. They start producing. So all those actions were taken so that they can provide a flow of money into the economy. They can boost the economy, provide the infrastructure to those who need to do the business, and once the business will start, employment will generate, production will be there, people will get the money, they will spend, so things will go very smoothly. So, in short, this is how the economy, the government, the central bank have actually come up to support the economy. But still, the focus was only on the money supply, but there were some fundamental weakness, okay, which were not properly taken care of at that point of time. So, because of which there were liquidity crunch. Because see, even if you are giving a loan to the corporate houses, even at the attractive rates, they might take the money, they start producing, but what if the demand was not there in the market? So many things were overlooked, even the money provided by the governments to the bank, that they can freely provide the money to the market so that they can grow that money into the business, things become smoother. But it took time, it was not immediate, okay. We have seen that more than 1.5 or 2 years it took to bring the economy back on the track, okay. So I have covered all the points. Now only thing which you need to do is to prepare a proper chart so that you can revise it, okay. Thank you.